Hi, everyone. Today, I want to bring to you a very special series that we've been thinking about for a long time now, which is to bring in a data driven approach to analyze mutual funds, to dissect the data that we have around mutual funds and see how we can identify the best funds that are out there. Before I get into talking about how do we do that, I want to start with one of the categories that most of us are aware of, which is the large cap mutual funds. Now, let me quickly define what are large cap mutual funds, and then we talk about how do we analyze them. As the definition goes, the top 100 companies in market capitalization is what we define as large cap. In fact, that's how SEBI defines it. And here is a report that I have from Nippon India around how large cap funds are defined. So at least 80% of the fund has to be invested in large cap companies, 80 to 100%, 0 to 20% in mid and small companies. So that means you might as well don't keep any money into mid and small cap, or you can go as much as 20% in mid and small cap companies. Then you could also do the same thing with debt and money market instruments. So this is where the fund managers can switch from equity to debt or liquid or even cash instruments. So I could have as much as 0% to as high as 20%. And interestingly enough, they could also put about roughly 10%, 0 to 10% of the fund in REITs or InvITs. So this is how a large cap mutual fund is defined. With that background, let me talk about what metrics can we use to identify the top mutual funds. Let me give you a fair idea on the numbers or the number of large cap mutual funds. So there are roughly about 100 large cap mutual funds. I think given the number of schemes, including direct, regular, IDCW, dividend paying mutual funds, fund schemes. So all of these included, the number of combinations are nearly 100. So there should be a way for us to cut down that number to a smaller number so that we can do a comprehensive and a very detailed analysis on each of these mutual funds. So I will not get into each and every mutual fund, but I'll give you an example of how can we do it so that you can do the same thing at your end. Let me first start with what are the metrics that we can look at to cut down this number to a smaller number so that we can analyze these mutual funds further, right? And by the way, this is not a recommendation per se. This is just to educate you on how can you do this yourself. So coming back to the metrics, so there are three key metrics that we look at least I look at. So one is the 3-year rolling return or rolling returns, to be honest. Then the second is volatility, and the third is the max drawdown. So these are the three metrics that we typically look at to cut down the number of funds that we need to look at from 100 to maybe, let's say, 10 to 12 funds. And from there, we can further analyze them and see how they have performed across time periods and see which are the top mutual funds, right? So the first metric, which is 3-year rolling return. I want to give you a minute. I think we've emphasized on this enough, but I want to demonstrate this once again, that why is it important to look at a rolling return versus a CAGR or a point-to-point comparison, right? So I'm seeing this a lot on quite a few popular websites. They show you a 1-year CAGR, a 3-year CAGR, and a 5-year CAGR. And that could be very misleading if you're making your decision on putting your money into a mutual fund just based on these metrics. So, well, that could be a metric, but you shouldn't stop there, right? And whatever I'm explaining in this video is just scratching the surface. There's a lot that you can do before you actually put your money into it. So let me show you this. So if you look at this, I'm looking at the NAV data for Nippon India Large Cap Fund. It spans from Jan 2013 to 22nd August 2025, right? And here is the NAV number. Starts from 14.69 to 102. So what I did was I calculated the percentage change, or the daily percentage change, and I've computed the NAV based on this percentage change. So just to make the comparison easy, I wanted to start with 100 as a number and see how the NAV has increased for this fund, right? So if I start with 100, then I essentially add the growth of this fund to 100. So since it has grown by 0.23%, so you can see that it is 100.23 now. And from 100.2, it has again increased by 0.5%, so which has further grown to 100.7. So on and so forth, you build the NAV for this fund. Now, once you do that, you can create what you call a 3-year rolling return. One way to do that is you calculate the CAGR, a 3-year CAGR, assuming about 252 days, trading days in a year. I assumed 3 years would contain 756 days. So what I did was E756 by E2, which is your first NAV number, to the power of 1 by 3, which is number of years, minus 1. So that gives you the CAGR value, a 3-year CAGR value from 2nd Jan 2013 to 29th Jan 2016. So that's approximately 3 years time, which we are looking at, and the CAGR is 15%. Now, as you move forward, what you're trying to do here is you're calculating for each day. If you measure the 3-year CAGR, what would that number be? So this is how the numbers look like, and you go up until 22nd August 2025 to calculate this CAGR number. If you are looking somewhere, a 3-year return or a 3-year CAGR number now for this fund, it would be 22.1%. But what I'm trying to say here is don't just look at this number. It's important to look at how were the returns, how did these 3-year returns change over time, and how did this fund perform in different market conditions and market regimes. So the latest 3-year CAGR is 22.1, but if you scroll up further, at one point it was much lesser than 22%. It's in the range of 10 to 11%. There was times it was less than 10%. There were times it was in the range of 18 to 20%. So it's important to at least acknowledge that this is the 3-year number for the last 3 years. This number, 22.1% that you're looking at, is just one data point, the latest data point. But it's important for you to understand that there are more data points for you to look at. So what we do here is we take an average of all the 3-year returns, which we call it as 3-year rolling return, right? Similarly, you can calculate a 5-year rolling return, a 7-year rolling return, depending on when the fund was launched. So this is just one metric. Then the other metric that we look at is annual volatility. So this is essentially the standard deviation in the daily change. So you can simply use a standard deviation formula to understand how this fund is fluctuating on a daily basis. So once you get the daily fluctuations in standard deviation, you can multiply that with square root of 252 to get the standard deviation, or what you call as annual volatility of that fund. And remember, we multiplied that with square root of 252 to convert the daily volatility into annual volatility. That's as simple as that. So 16.8% is the annual volatility. There's also a way you can get the max drawdown from just these NAV numbers. So here you basically try to do a calculation to get the max NAV. On day one, it is 100. On day two, it is a max of that number and the previous number. And you go on till the end once you get the max NAV, which is nothing but you're trying to understand at every point what was the peak, right? So if you look at today, the NAV is 694.4 and the peak was 699, the last peak, right? And drawdowns are nothing but what was the change of your NAV from this peak. So if you see the formula here, what we're trying to see is, this is the peak F3 and this is the NAV. So E3 by F3 minus 1 is the change that you're trying to understand from your peak. So the lower it is, the worse it is. So as you can see, as there are occasions when the drawdowns are higher to the tune of 18 to 20%. We will see what the max drawdown number is in another tab. So I've done this analysis for nearly 100 large cap mutual fund schemes. And what I did was I filtered the top 10 based on these metrics. Now, this is the tab where I have these top mutual funds based on 3-year rolling return, annual volatility, and max drawdown. So as you can see, on an average, a 3-year rolling return is 16.5% for Nippon India Large Cap Fund. Annual volatility is in the range of 16.8%, and the max drawdown is minus 40%, right? So these funds are very close, though as you go further down, you're seeing there is some significant difference between one fund to another fund, right? So at the end of this video, I will also talk about one of the funds that were not performing great. Here, we kind of looked at what are the top large cap funds, but we're not going to stop here, right? It's important to further dive deep into what's really happening with these funds. So let me take you to the tool that we have and see if we can compare these funds with the benchmark and see how they are performing. Let me start with the top fund that we have seen in the previous table. I will just give weight as 1 and run the back test. So essentially what we're trying to do here is comparing Nippon India Large Cap Fund with the Nifty 100, which is its benchmark, and see how that fund is performing. So as you can see, in the initial months or roughly about a year or so, this fund was underperforming the benchmark and slowly it started beating it. And there was a time it was very close to the benchmark, which is, I think, during the COVID time. And post COVID, it again went beyond the NAV of the benchmark, which is Nifty 100 here. So the blue line is the fund and the red line is the benchmark. So variation 1 is the blue line, variation 2 is the red line. And here, as you can see, the blue line, which is the fund here, the large cap fund, was underperforming the benchmark in terms of the drawdowns as well. It was closely hugging. It was very close to the large cap to the benchmark for a long time. And again, during 2018, early 2018, you're seeing that this fund was again showing a larger drawdowns compared to the benchmark. Also during the COVID time, you can see the fund has took a longer time to recover, or it was showing higher drawdowns compared to the benchmark. So if you see in the recent times, I think it is doing well. In the first half of 2023, you see the fund is showing lower drawdowns, and in the recent times, right, it's very close, and now we are seeing that the fund is again performing better in terms of drawdowns. Now, let me give you a glimpse of the monthly returns. I'll just allude you to the last few months in 2025. So you can see this is the fund and this is the benchmark. So in Jan 2025, it did not perform well, but after that, it I think started taking off. It is very close to the benchmark. In July, it was minus 1.7%, whereas the benchmark is minus 2.7%. Again, August, it started picking up. So let me now take you to the the 3-year rolling returns. And before that, let me show you the max drawdowns, right? Has a max drawdown of minus 13.96%, whereas benchmark was at minus 37.9%. If you see here, the max drawdown is 563 days. So it took 563 days um, to recover, and that was the highest in its history so far. Whereas the benchmark took about 506 days to recover. Now let me show you the 3-year rolling return. As you can see, given that the fund has a slightly higher volatility than the benchmark, obviously you'll see a wider range of outcomes coming from the fund as opposed to the benchmark. So here the mean is 16.9%, the median is 16.6%. So if you're lucky, you would have if you're lucky, you would have got about 37% CAGR. That was the highest it had in any 3-year period. And if you're unlucky, you would have got about minus 5.3% return over 3 years. So that was also a possibility. And this is one thing that I'm alluding you to, that there are multiple possibilities. If you're just looking at one 3-year period and making a decision, then it's not very prudent for you. You need to make sure you're looking at these data points, and you should know that this is also a possibility for you. Whereas for benchmark, if you see, the 3-year max is about 33%, the mean median hovers around 14%, and the 3-year minimum is minus 4.4%. And lower funds is roughly about 3.4%, whereas the lower funds for the fund is minus 2.1%, 2.7%. So if you are looking at these, so if you put this box plot on a timeline, this is where you see the 3-year rolling returns. So initially, the fund was doing better than the benchmark. Then it started getting closer to the benchmark. And again, it went above the benchmark. In fact, this was the time it was below the benchmark. And as you move forward in 2023, roughly, it started beating the benchmark. So there were times it was not doing well. There were times it was doing well and continued to do well. Similarly, for 5-year rolling returns, you'll see that for before COVID, it did well. During COVID and right after COVID, you see that the fund was not performing over the benchmark. And after that, for a good amount of time, it was just doing as much as the benchmark. And recently, it started performing over the benchmark. So here you can see that the 5-year rolling returns, and this is the 7-year rolling returns. So the magnitude of difference between the fund and the benchmark is small. It's still small with 5-year rolling return, but with 7-year rolling return, you're seeing that the difference is kind of medium. So the longer you are staying in this fund, the higher the chance that you're beating the benchmark. So this is how you can further dive deep into one of the mutual funds. So I'm trying to repeat myself that you don't just look at few numbers to make a decision on which fund is doing well. So you need to make sure that you're looking at both return related metrics, risk related metrics, drawdowns. How did the fund perform across different regimes, different market conditions is quite important before you make any decision on is which fund is performing better. Now, I just want to give you a flavor of another fund which is probably not performing better than a benchmark, which is in this case a DSP large cap fund. So if I run the backtest, mind you, the red line is the benchmark and the blue line is the fund performance. So you can see the red line is constantly or consistently on top of the blue line, which is the fund. And even with drawdowns, you can see that the fund is as good as the benchmark in terms of drawdowns. There were times after the COVID where it was lagging behind the benchmark. I think only recently we are seeing this fund is doing better than the benchmark. So this is the time period when it started doing well. So only recently we're seeing blue having a lower drawdown compared to red, which is the benchmark. So I will straight away move to the 3-year rolling return, or actually let me show you the max drawdowns. So the fund is at minus 40 versus the benchmark max drawdown of minus 37%. So there was a time the fund underperformed, or you're seeing a larger drawdown compared to the benchmark. Volatility is also slightly high. So let me show you the 3-year rolling return box plots. So you can see this box plot is slightly above the blue box plot, which is the fund performance, right? So as you can see, this is happening across time periods, 3-year, 5-year, and 7-year rolling returns. As you can see here, if you put this on a timeline, the fund was below the benchmark for quite some time. Only recently it started doing better than the benchmark. So I'm not sure if there is a change in fund manager at this point, but we're seeing that the fund is actually doing better now. Uh, Obviously, since we are seeing this performance only recently, on a 5-year time period, you will not see this difference. And a 7-year rolling return also, you will not see that this fund is performing better than the benchmark. So, so that's it, guys. I just wanted to give you a tour of how can you analyze mutual funds. We started with defining the large cap funds. We then talked about what are the metrics that we look at to reduce the number of funds that we analyze to a handful number that we can actually look at. So then we specifically zeroed in on two funds. One is a high performing fund, one is a fund that is not beating the benchmark. And we looked at a number of metrics across time periods for these two funds versus the benchmark. Again, this is not the end to it. There's a lot that you can do on top of this to further understand which fund can perform better in which conditions. You can actually do a Monte Carlo simulation also on top of this, which is discussed in one of the videos. So that's it, guys. Thank you so much.